Hey everyone, welcome to Retire with Style, and I'm here with my co-host Wade Bao and another special guest here, Branislav Nikolic. And just quick trivia, two of us are in Canada. One of us is not for this episode. If you write in, you'll get a free copy of Wade's book if you guess who's in the US. Right, Wade? Is that right, Wade? Am I ruining the sales numbers if we do that? or are we
I think we
good?
got.
All
Yeah, you should
right.
probably be asking Bree if she wants to manage the whole process.
Sorry, Bree. That's the she sort of organizes everything in the background. But Branislav, thank you for joining us, man. Really, really appreciate it. I think you're one of the rising stars, within the industry as far as insurance annuities go. I really do think so. And so it's actually kind of cool to bring you on the show simply to get your take on the state, but more specifically on indices and the like, as we've been discussing on previous episodes, specifically with regards to fixed index annuities and RILAs, how there's an index that they effectively track. But before we get into all of that, can you tell our lovely listening audience a little bit about yourself?
Thank you, Alex. Thank you, Wade. Thanks for having me on the podcast. As Alex mentioned, my name is Branislav Nikolic, and I've been with Index Standard for last 6 months. So fairly with both foot on the ground. Prior to that, I was with Canex, a data analytics provider, and I've spent last 10 years roughly working on annuities, their allocation within a portfolio, um, basically optimizing the annuities themselves, anything from optimal utilization. And I had a pleasure to work with Wade and Alex in my past life. So hence the invite, I guess. But I think the topic is more of like what I do now. And I'm leading the insurance initiatives at Index Standard. Index Standard been founded around 2.5, 4 years ago, but Lawrence Black. And what we tend to do is help people understand indices that are utilized in structured products and annuities. Demystify what these things are. See if we can bring it down to the level that it's acceptable for people to just read our reports, understand our ratings, see what our forecasts are for the future, and how to use this to optimally allocate within annuities. Again, I'm really honored to be here. Thanks for having me.
Yeah,
No, no,
thanks,
no.
Branislav. And
Go on, Wade.
point of clarification, just to be clear. So, what you do with the index standard, you're evaluating other indices. You're not in the process of creating
That's
proprietary indices.
that's correct. So the founder of the index standard, Lawrence Black, he was in the business of creating indices and is behind some of the very successful ones. But he thought that instead of creating more indices, we could use the expertise to evaluate everything that's in the market and see if we can add a layer of information that could be useful for the advisors, consumers, product manufacturers, and likes.
Yeah. And this goes to your point, Wade, that you've said in previous episodes that sometimes it's hard to make comparisons, especially when people have different indices, to assess the quality of the underlying. And so I think this sheds light. But before I get into that, I have two significant questions I have to ask Branislav about. All right. So is it Dr. Branislav, or are you like Wade that was like 10 years ABD?
So, yes and no. So I
Yes,
defended,
no. Uh-oh.
yeah, I defended on May 4th, but I'm yet to wear a silly hat. So it's somewhere in
That's good
between.
enough.
I'm your Doctor Elect.
Yeah, yeah. You know what? Truth be told, I never attended my graduation. I never like wore a hat or a gown or anything. I just got by that time I got it, I'm done.
The feeling is mutual. So yeah, the hard part is done now. It's only festivities left.
Yeah,
And
yeah,
was
yeah.
Moshe Malevsky on your committee?
he was actually
know you're
chairing my committee.
okay.
Not just being on it, but
Yeah.
chairing it. So, and usually the role of the chair is relatively ceremonial, but everyone who knows Moshe, he made sure that it wasn't that. So I had a very good examination. So proud to say that.
Congrats,
Well,
by the way.
congratulations.
Yeah. Thank you.
Now,
Thank you.
the other main question, and I think after this question, I'm done with the entire interview. To be honest with you, is it pronounced Efi or Ifa?
MSCI.
Yeah, that I whatever. Is it Efi or Ifa? Where do
Look,
you come at?
I give you my rendition, but I'm an ESL kid myself, so I just go with whatever is in the moment. So I'll be in your team.
There's no answer. There's no. Did you see Wade? He's like a politician. This guy. Is that what you did in your dissertation defense? Is that how you answered? No, Efi or Ifa? You got to give me an answer, man. What team are you on?
I would say Efi.
Really? I'm Ifa. But maybe it's a
And just
Canadian thing.
for those listening, that's one of the standard international indices that gets used. But that might just a good place to start, just to level set a little bit. What even is an index? Or what do we mean by the idea of an index?
So the way we like to think about indices is that they're, again, nothing but the set of rules that would give you exposure to different types of assets, loosely speaking. So it's one can think about it as a portfolio, with a caveat that you don't actually own what's in the index. And this really goes into when you say I'm invested in an index. What does that mean? I'm invested in something that usually tracks the index. Index would be the way or the recipe that you would put things together. But usually what you're invested in is either an ETF, exchange traded fund, or structured note or an annuity. So that's the way I like to think about this.
And yeah, classic indices that are out. That's another question. Is it indexes or indices? I think I've seen it both ways.
Absolutely, yeah. Are you team indexes or team indices? Let's just get this all out of the way.
So I'm indices, but I
There you
believe
go.
that the common US editor would correct it all to indexes. So that's, again, I think it's
Yeah.
a stylistic preference, but the way we actually wrote a piece that's gonna come out as a part of a NAFA, a National Association for Fixed Annuities, education series on actual indices, and we basically try to put this into some common buckets. You have benchmark indices that started on as just a gauge of how an economy as a whole will be doing, or the sector of the economy. Then you have thematic indices, something that is basically output of someone's research or someone's idea on how to put assets together. Everything leading to, for example, ESG indices these days that are being utilized more and more. So, wait, I think going back to your question, when we talk about indices, what are we talking about? When we're strictly talking about the annuity space, more often than not, you're either team benchmark or risk control or volatility control type index. They
Good
could be
point.
either multi-asset, and then have some form of the volatility control mechanism. Now, I'll let you ask. Probably you're going to ask, what's the volatility control mechanism? Like,
Yeah, we definitely want to get into that. But yeah, the benchmark indices, that's like the S&P 500. That's the one we've talked about the most in past episodes. But you've got, I always just said EAFE, the IFA. That's a common international index. You've got like the Russell 2000, which brings in more of the small cap side than the S&P 500 gets into, and so forth. And then, right, we've talked about just generally the S&P 500 because that's one that most companies will offer, and so it makes it easy to say, well, if company A's got a 12% cap on the S&P 500, company B has a 10% cap on the S&P 500. That tells you a little bit about like how much options budget is available. But the real interest, it's
The only
with the
thing, Wade, I would
volatility
say,
controlled.
just to make sure, Wade, again, this is where we struggle with this arc a little bit because we talked about certain concepts already. This is within the construct of a fixed indexed annuity, and later on we'll be talking within the construct of a registered index linked annuity.
Well, and whether there's even any difference, really.
That's fine.
Good question. But yeah, the volatility controlled indices is where a lot of the action is. And why is that, Branislav? Like, what's the motivation at a basic
there
level?
are two key elements that affect. So you said a keyword, option budget, and option budget is a reflection of where the interest rates are. And in the past decade, we had interest rates near zero, and they were consistently very low. So usually, where you get your option budget is from the rate that you can invest in your general account. If you're an insurance company, you invest your assets and you get rate of return, and for that you can buy some options to offer your fixed index annuity payouts. Now the benchmark indices, as the name says, like benchmark, they were never meant to go into anything. They were just meant to benchmark, and as such, they're a true gauge of what's going on. So they're volatile at times, and if you have a small budget to buy something that's very volatile or very risky, you cannot give much of the exposure. In other words, what you were mentioning before, you said company A offers caps of 10 and 12. Have we had this conversation 2 years ago, 3 years ago, we would be talking about 2, 2.5, 2 3/4, and talk about competitiveness. So that tells you about the responsiveness of these options that you're buying through the FIA to benchmarks. Now, that's one aspect. The other aspect is volatility. So in order to reduce the price of that option, you need to tame the volatility. And this is where the volatility indices came into the game, that if you can offer an index that would perform certain actions, most commonly just shifting between, let's say, cash and risky asset, you can bring down the volatility, make the option cheaper, and offer more participation on such an index. Then the key is that you then expand kind of the field of who can play in that arena. So we've seen a lot of asset managers that went into the arena, and a lot of obviously banks who are on the other side of those deals, providing these options to the insurance companies to begin with.
Yeah, and probably we should so a 15-second refresher on how an FIA works, because it's something we covered in past episodes. But the idea is you pay this premium and it has principal protection because the insurance company buys enough bonds so that when they earn their interest, you have principal protected. Then with the remainder, the insurance company keeps part for themselves. The rest goes into this options budget used to purchase financial derivatives, such as call options on the index, which provides a payout if the index gains in value, the price returns of the index gains in value. Now, when you get into that situation, interest rates become very important, because the higher the interest rate, the less it takes to protect principal, the more that remains to purchase upside exposure to the index. And then the price of the financial derivatives is very important. There's several factors that go into that, and the most important of which is the measure of implied volatility, that the more volatile the index is expected to be, the more expensive those options are. And if you have to spend more on those options, the less upside exposure you get. So but that's the whole idea. Then if you use a low volatility index, should make the options cheaper. You should, like, the low volatility index might give you a higher cap than the S&P 500, for example.
Usually these come only with a participation on it. Usually they're not capped. I think that's another, if you want to go into the marketing realm of why they took off, is that usually you can go around and say you get a participation, but there is no any cap to it. Again, it's like half dozen or the other six. You can really structure this any way you want, but the key point is what you just mentioned, is the lower and, more importantly, constant or close to constant volatility, because the big question that is posed in the industry is how consistent these annuity parameters will be through time. I understand that these are today that I'm buying the annuity, but in a year's time, will you be able to what it's called renew at the same or similar rates? And these volatility control indices, because of the relatively smooth volatility structure, can offer that with a higher consistency, and that becomes very important at the advisor level. What happens at that 1 year or a 2 year statement review? Did you get a credit in your FIA? What's going to be the profile of your payout for the next year, and so forth. So I think between those two things, extremely low interest rates in the past decade and the stability of the annuity parameters, we see roughly 60% of the premium being allocated to these call them custom or non-benchmark indices in the market.
And has this been a steady increase over time, or is this just, just when interest?
Relatively steady increase, and obviously with more players coming into the game. So at any point in time, you have around 100 or so of these indices utilized in the insurance space.
And so this is where you saw. Sorry, go on, Wade.
Well, I guess then this may be where really what the work you're doing at the index standard comes into play, because someone might think, well, if this is an index that has less volatility, maybe it has a lower expected return as well. And then if I'm thinking, well, if I have a higher participation rate on this index because it has less volatility, does that even matter? Because I'm not expecting a higher return anyway. And so what should I pick? Index A that has a lower participation rate but a higher expected return, or Index B that has a higher participation rate but a lower expected return? Is that where you're coming into the picture?
Segue. That's a perfect segue. So again, now it goes shameless plug. So what we do is that we assess indices on their own. We provide a rating, and we provide a forecast. Rating, we look into how well the index is constructed, how transparent the rules are, and again, anything to do with the past returns. We take into account very important bit that all of these are developed with the benefit of a hindsight, because you have to provide a back test. In other words, how would have this index performed in the last 10 years, for example? So we look into the measures that would assess the returns in a back test versus since index went live, and basically assess the index for its quality. Then the second step is that we take the capital market assumptions and basically forecast for 10 years from over 35 either investment banks, insurance companies, asset managers, aggregate these, and through basically a DNA analysis of each and every index, we are able to, based on these kind of now common capital market assumptions that we call wisdom of Wall Street, forecast what each of these indices we see doing over next 10 years. We provide conservative, moderate, and a strong forecast for it. But where rubber really hits the road is that we combine that now with the present annuity parameters. So you have a forward-looking index returns, and you have annuity parameters, participations, caps, fees in some cases, and we are basically trying to level set and allow for this comparison between different annuities with different crediting strategies struck on different indices.
Okay, so if I can maybe reiterate this just to make sure that I understand it. So what you folks do, and your audience, I would imagine, are financial professionals, right? Or carriers or the like, not necessarily end consumers, correct?
So
and that's fine.
For the benefit, we do this for the benefit of the end consumer. So to us, it's important, but we can debate who the end consumer of our material is. So I think the ultimate benefit is for the person buying the annuity, because their advisor will be able to tell them difference between index A and index B, and help them explain the choice that they're making together ultimately.
Okay, and so to Wade's point about how, there's an FIA and one of them is tracking this, the other one's tracking that. based on what you said, you have three layers. The first layer, you're just going to quality review them. Okay, and I may not be saying this the right way, but okay, this index score is at a 9. This index score is at a 9.5 in terms of from a
We make
quality
that even
scale standpoint.
simpler. Yeah, we make that even simpler. So we have like almost like a medals. So we go from
Fine, perfect.
platinum, gold, silver, copper,
Yeah.
and that basically gives you the categories of what it
Perfect.
where
Okay,
those index.
so you're at least able to assess. You know, the Russell 2000 is not the same as the S&P 500, but for the purposes of the analysis, they both end up getting a silver medal, or they both end up getting a gold medal. So you can kind of assume that they're in the zip code. But then so that's the first layer.
Indices get medals.
You're asking the
Sorry,
right
what?
question. So what we do is we also group indices alike. So similar to how you would not rate equity fund with together with a fixed income fund, we group like indices, and they get ranking and categorization in their own arena.
Got you. Okay, so it's on a relative basis. But then that's the first layer. Then you sort of bring up the forecasting, and the forecasting, obviously, caveat emptor, all that kind of stuff. But the forecasting is a consensus-based forecasting. Is kind of what your sense of, and it's almost. It may not. I use this term very loosely. It may not matter the accuracy because what you're looking is on a relative basis, the wisdom of the crowds has sort of set this general forecast for this particular index, you know, and so that helps kind of equalize, I think, comparing different indices to each other, because proportionally the inaccuracies would be the same.
It does, but also the important bit is that the rest of your portfolio planning or asset allocation or product allocation even will be done with some capital market assumptions in hand. And we are trying to basically say this is what kind of is in the same units of measure. You can perform this and allocate to the annuity as opposed to using the backward looking. I'll give you an example that I always like using. So take the benchmark indices, whether it be Nasdaq or S&P 500, and you see Apple being the major part of that. Obviously, much more in Nasdaq than on S&P 500. But Apple, if you look over last 10 years, had like annual returns in around like 17-18%. So if you or let's say Nasdaq had that as the last 10 years. Now, if you grow Apple at that number, you'll get Apple in 10 years having the market cap 3-4 times the GDP of Germany. So the question is, should you use that back test in your planning? Is it realistically to expect that Apple will continue to grow over next 10 years the way it grew over last 10? And how sustainable that is, as opposed to looking into consensus of where we see the for example, technology going over next 10 years that we see in these capital market assumptions from
No, I think it's fair to say Wade and I subscribe to that. I mean, when we did a whole arc on planning, you know, it comes up, do you use historical returns or do you use sort of forward-looking returns? And you'd be foolish, maybe too strong a word, but you'd be, you know, silly not to just, you know, assume that, yeah, Apple's going to return 17% for the next 20 years because that's what it did the previous 20 years, you know, that kind of thing. But that's the second layer. And then you add one more layer, which is then you look at the annuity structure in which that index is in and what the parameters of those are to kind of try to uniform them all out.
That is correct.
Right.
So basically that provides that apples to apples comparison, and we compute for each crediting strategy in every annuity what we call net forecast credit. So basically it's again a simulation that takes our index forecasts into as its base. It layers on the annuity parameters, and for each crediting strategy, we are able to give you something that's equivalent of a rate of return net of all caps, floors, fees.
Yeah,
if you want to think about RILAs, buffers, and etc.
So wait, do you think this satisfies your concern, or again, satisfy, the word choice here, but does this satisfy your concern in previous episodes when you said, listen, there's no way to really compare these FIEs from an apples to apples comparison because they're using different indices to begin with. Does this go towards maybe allaying some of those concerns a little bit?
Yeah. I mean, this can go a long way. Yeah, really, what I was saying was just it's the easy, if you want to compare different companies and try to think about which company would I like to go with for the annuity, it's easiest to compare them with the S&P 500 because most of them have that offering, and so you're able to see what they're doing with it. When you start getting into the proprietary indices, there's less transparency because it's harder to compare. But no, I think that's where you're stepping into this missing gap in the marketplace to provide a service to make
Shall I
such
call my
comparisons.
marketing department and say that we got just endorsement from Wade Files?
Yeah, it kind of sounded that way, but yeah,
No,
well, another question though on these comparisons, like with this idea of volatility controlled, it means there's something dynamic going on that, and you said earlier, when markets becoming more volatile, it may push more into cash. You're actually simulating those rules as well when you're doing this sort of forecasting about the future performance?
So we do our factor or DNA analysis of an index to basically see where the index is exposed, and it's almost impossible to replicate every index for a go forward basis. But our factor analysis gives us the average exposures that index had, and we apply those on a go forward basis. So again, everything that
you're effectively saying this index has a beta to value of, I don't know, 75, to cash of this, to size of this, and the R square is 95, so that's good enough, and we're going to replicate it.
So basically, we do two things, I think, at two layers. We do a DNA type analysis, which basically would say geographical or the asset class exposure. And then we do finer of a blood type thing, which is value, growth, momentum,
Sure.
size. And based on these two set of factors, we are able to forecast these on a go forward basis.
Nice.
Now,
And
wait,
so,
one important thing that I got asked recently, how you can use what we produce, is that someone said, like, okay, like, you're giving me all these exposures. That's good for you guys who are technical. But if I'm looking for an index to give me a good protection against inflation, how do I see that in your analysis? And then you would basically then see the exposure to commodities, exposure to gold, and say these were historically a good inflation buffers. So you may want to choose index that has decent exposure to these, as opposed to cash or just plain treasuries.
okay.
And that is something that's out there in the annuity space, with going beyond just stock type indices.
Oh, absolutely. So we see categories that are multi-asset. And again, the progression was that you had your benchmarks, that you had the volatility control, then like different versions of like doing that intraday as opposed to on some fixed time scale. Then what we saw in the last couple of years coming in is like the commodity curve plays coming into this again to try and battle the inflation, and haven't seen that commodities did reasonably well over last little while. So you have more than just, to your point, more than just your stocks and bonds or equity and cash. These are now like multi-asset quote unquote portfolios that have these mechanisms that would rebalance them to smooth and cushion the returns of an index itself.
And at what point, if I'm a consumer, I'm listening to this, and it's interesting, there's a little meta thing going on. And by that, I mean, like, okay, the FIA structure in themselves are creating that kind of buffering mechanism. That buffer alone creates it. But then, interestingly enough, the underlying index of that product does their own internal kind of volatility control, from a pricing standpoint. But do you see how there's a little meta thing to that?
So are you over-insuring? Are you
Oh yeah,
overprotecting?
yeah. And then
Let me
and
give
where
you.
I'm going with that is, it sometimes in any industry, right? Does this provide an extra layer of fees that's necessary? I'm sure the answer is yes, but there's always this balance, right? Where people just spot an opportunity, a market opportunity, and go crazy with it. So,
The way I see this, and again, like I can give you kind of the common example that I always give is that when it comes to the FIAs, where do these go? These go to retirees, and these credits on an annual basis are sometimes the money that people will take out and live off, absent having any guaranteed income rider on them. So the key is how consistent you want these to be. And to me, these volatility control indices provide not another layer of protection, basically to double up. Obviously, the FIA will protect your floor, you will not lose your money. But the key is how steady those credits will be. Will you get a positive credit of a similar amount, let's say 7 out of 7 years or 5 out of 5 years? In other words, if you put it in baseball terms, you can win the game in different ways. The way we
yeah.
see the volatility control indices is your lineup stacked with the guys who can hit singles and doubles, and you get your runs along the way. Whereas with the let's say benchmark, let's say the S&P 500, you can hit it out of park 5 out of 7 years, but 2 years you may not. On average, the index did fairly well, but in 2 years you may not get the credit. Again, you can win the game that way as well. It's really coming down to a preference, but I don't think the game is either or. I think it's diversification. Look into exposing yourself to more than just one thing, because that's good. The only free lunch in finance is diversification. And the other one is that I think single allocations to a single index are starting to be problematic from the suitability or best interest point of view, and even compliance point of view, that you basically have, in a lot of cases, a lot of premium going towards S&P because that's the only thing that people are familiar with. And we are trying to bridge that gap as well, to make them familiar with something else. And if still decision is it's better to go with index ABC, so be it. But you made an informed choice as opposed to this is the only thing that sounds familiar.
No, listen, I think you're right. Even from an investment philosophy standpoint, I'm not going to quarrel with somebody putting the money in the S&P. It represents how the average investor in the U.S., at the very least, chooses to allocate their capital. But how much you reflect the average investor from an income standpoint or from a needs standpoint probably deviates significantly. And so to that extent, that's where, these sort of levers can come into place nicely.
Yeah. The other thing that plays, again, plays interesting in this, and we did a bit of a study, is that over last 2-3 years with the rates coming up, you see, for example, the cap rate on S&P or the participation rate on S&P doubled or tripled, right? On these proprietary indices, if you look into, let's say, 50th percentile, I mean, the percentiles are moving pretty much in the same direction, but you see that the participation in index increased by 20-30%. So we had a huge jump in interest rate, yet we didn't see the much of a budget in the parameters. That tells you that these are relatively stable. If interest rates start coming down, you can expect the same thing, reverting back to where we were. So I think it's more about consistency and steadiness of what these provide on a return side.
Well,
That said,
it's kind of Wade's initial statement, where it was like, well, if you can get a steady return, you can get more participation. You can get more, more can go down. You can send down more in income to the consumer if you have that predictability, because people can just budget their business a lot better.
Another thing that with the increase in interest rates we are seeing now, you see that these participation rates are starting to get to numbers that are 200, 250, 300%. Basically, you don't need your index to do much to get a decent return, right? So I think that basically the technology that was developed to squeeze something out of nothing over the last 10 years now is being used when you have more than nothing to offer. And I think it's just more efficient way of doing this. And again, these indices were developed to be inside of other products. They were meant to have options
Yeah,
to
they have
have.
more purpose. They're not indices that are just benchmarks, to your point. They're not indices that were initially just meant to see how good active managers are doing. These indices have purpose, and that purpose is to provide that steady stream of income. And technology and science moves forward in the way of what you're doing. That's kind of my takeaway so far.
Yeah, I'll just correct you. You said income. I would say returns, steadier
Okay,
returns.
okay, fair enough,
I,
fair
I,
enough.
I don't like. I'm still in the annuity purist camp mostly, in saying that
It's fine.
the income and guarantees come from a different place. But if you choose to use these FIA returns for that purpose, this gives you the level of steadiness that doesn't exist with, let's say, benchmarks.
Branislav, a more basic question about this. When a proprietary index is created, how does that work about then creating a financial derivatives market around that so that options are being traded? Or is it more, that part is also more proprietary in nature?
So the simple answer is that usually they come hand in hand. So you would have index provider, usually a bank, have their trading desk provide you with the over-the-counter derivatives for it. If you're an asset manager, you probably would again partner with a bank who would provide you the derivatives for it. And if you're a big indexer, again you're looking for someone like a bank, but the big indexers will have more generally available components in it, so they can get bids from different banks. But it's that layer, and then the argument goes that you may be a little bit more efficient if you're getting all of it at the same place.
Okay, and that's also maybe a reason why they use participation rates more than caps, is because caps requires a second layer of, you need derivatives that are different strike prices and everything else.
You need to sell as opposed to just
call options that
so,
at a different price.
I think that it really kind of goes, because again, like you're selling the call that's really out of the money. You might as well just keep that and keep the story around uncapped, which again has got some got into some hot water lately. But I think that the appeal of like offering uncapped exposure to an index is there in itself.
And you mentioned a participation rate of like in the ballpark of 200%. Could you clarify, was that a cumulative return over a multi-year term, or is that like a one-year term you're leveraging? If we say a participation rate is 200%, that might indicate like if the index was up 5%, you're going to get a 10% credited interest. Is that what you're?
Basically you get, let's say go the simplest of like 1 year point to point. In other words, measure your performance of an index on an annual basis and apply participation rate to it. If we are strictly speaking about the S&P 500, you may get 70, 80, 90% participation. But if you're talking about, again, another S&P derivative index that's volatility control, you may get 120, 150, 160. And if you're talking a bit more complicated, again, S&P branded a volatility control index, you can get even 200%. So basically, if that index itself does 2%, you get 4. If it does 5, you get 10. Then we can start to stretch that over multiple years. And indices that would say, oh, if you start measuring on a 2 years basis or 3 years basis, I can offer you even more in terms of multiple on what index does over that period. So it's all these combinations that make this very hard, to your point, to compare. And this is where we try to kind of address this with the effective annual rate of return over a 10-year horizon.
Gotcha.
Okay.
And Branislav, what's the best advice you could give to an advisor who's beginning to be initiated in the world of annuities when they look at an FIA contract and they're trying to assess the quality of these annuities, other than use index standard for the results, and then by the default, what are some of the questions an informed consumer should be asking themselves when an advisor presents them with a few options that are based on underlying indices?
So I'll go straight to consumer, and that will
Okay.
inform advisor as well, right?
Fair enough.
So I think for me, again, having one leg in academia as well, is like, why are you proposing this to me? Is this for income or is this for accumulation? Because the story starts to diverge fundamentally in those two scenarios. If you're doing this for guaranteed income, then obviously look into contractual guarantees. These are insurance products. They're contractual guarantees. See how is contractual guarantee looking. See if there's any upside on it. Usually there's a trade-off. The higher the guarantee, the less upside, and vice versa. If you're looking for the accumulation, the question is, I'm using this for accumulation instead of what? Over the last 10 years, the common story was, bond funds weren't that attractive, the interest rates were low. Here you can get more of quote unquote yield. The question is, if you understand that this is a fixed income replacement or fixed income augmentation, that's good. I think a lot of misconception is that these are products that are exposed to they're somewhat tied to equity. I mean, they're not. They're exposed to a certain degree to the equity or multi-asset indices. So I would ask that question: what are we doing this instead? And then once it comes to a choice, it goes back to something that Wade was saying. How do I choose the insurance company? Did you choose your insurance company because you have some other reasons, or this is the best rated company with the ability to pay its claims, that they have the renewal rate integrity, and then go into the details of a contract. What is the annuity well diversified? Does it offer more than one option? How competitive are the options inside of the annuity? And ask, why pick one? Why not allocate too few to diversify even those credits coming in? For example, we said like 1 year strategy, 2 year strategy, a little bit of both. And then you can get maybe higher participation or higher exposure on a 2 year strategy, but let's say half of the money in a 1 year strategy will give you constant credit every year. And then again, how does this fit into your entire portfolio? And to understand again that these are fixed annuities, that if you see rates of returns on rate sheets or in illustrations that are in high teens, low 20s, there are questions to be asked. That has to do with a practice of illustrations and backtest and just kind of doing the arithmetic with all these numbers. But be sure that the right benchmark for this type of product is maybe 70-30 portfolio, 70 in fixed income, 30 in equities. Wade, would you agree with what I said? Did I miss something?
No, that's a good explanation. I think it made sense.
Yeah, I just wanted to hear from somebody outside of us that's that you're in it, as far as indices are concerned. So who better than to ask you about?
But I'll go to the obvious answer. I think using what we have to offer.
Talk your book, man.
The way is, I see it as ultimate cheat sheets, and basically we're taking the burden of having to know everything about every index, everything to know about every annuity, and kind of focus on the placement of that annuity concept. And that's something that kind of is more in line with what you guys are doing. Once someone is comfortable that some of the money should go into the fixed index annuity. They should not have any additional brain damage to select one and kind of research. That should be summarized for them and brought to the level that they can just consume that information and go with it.
Yeah, absolutely. And one other question too, because it came up a little bit earlier. So we've mostly been talking about fixed index annuities. There's also the registered index-linked annuities that we've talked about in past episodes. You take some downside risk in order to get more upside exposure. But my question then is, are there different motivations in the design of indices for each of those products, or is it pretty much they're designing the same index and it can be used in either type of annuity? Could you just talk a little bit more about that issue?
Yeah, so the way I see this on a sliding scale, I see RILAs closer to equities. Basically, equities with some downside protection. So I see them far, absent having the name annuity in it, I see them very far apart from the fixed index annuities that we discussed for the duration of today's conversation. So that's the first one. That these are not, in my mind, they're not comparable. One is very close to an ETF tracking S&P 500 with some downside protection. The other one is full principal protection with some exposure to S&P 500. So that's the first one. The other one is going into the structure of the annuity in order to get a little bit more exposure to positive outcomes of the underlying index. You're basically taking some additional risk. What does it mean? That you have to sell an option, and that better be something valuable. So you want something risky in it to be able to buy up your positive exposure. So to me it's a trade-off exercise between how much risk you want to take for how much return. It's not zero risk for whatever return. So that, for me, that's the cleanest delineation between the two. And then if you look into indices, again, I had this conversation with our common friend David Blanchett about this. Is that indices should not follow the same path. That on the FIA side, you should have more of a consistency, whereas on the RILA side, you want something that once you take some risk will offer you a lot more upside. That the option that you're selling is valuable because of the volatility that's embedded in the index itself. So you want something that's very equity-like.
If not, what's the point?
Yeah, it's like, and that was Alex's question earlier, like about double insurance. Like if you have a very volatility controlled index in a RILA, that might end up behaving about the same as an FIA, and then you don't have the potential for greater upside because there's also less risk built into the index.
Yeah, but to me, the biggest misconception is that these get to be talked about in the same sentence. I think that these belong in different paragraphs.
No, I agree. I mean, Branislav, I think we're close to the 50-minute mark, which is kind of our what's the flag before the checkered flag in a race? But
5 minutes, 5 minutes left in this time.
No, this has been great. This has been fantastic. I mean, I actually picked up the way you frame certain things. I've learned quite a bit actually today. I really thank you myself. You know, from that vantage point, I think it's been fantastic. Anything that we may have missed, Branislav, that you wish we asked you that we forgot or that we just didn't think of?
I think this was perfect. I truly enjoyed it. Thank you. Thanks so much for having me. And then if it was informative for you, I hope that it's informative for your listeners and or viewers.
Mostly listeners, some viewers.
Is that why Branislav emailed me before the podcast? Hey, are we going to be on video? And I was like, yes, but I should do a better job of that, huh, Branislav?
Just curious. Look, like casual Fridays when you work from home have a different meaning. Right?
Yeah, exactly. Yeah. But all right, everyone. Yeah. Thank you for joining us, Branislav, and everyone. Again, we don't make light of it. Thank you for devoting a little bit of your afternoon to Retire with Style. It's much appreciated.
My absolute pleasure. Thank you so much for having me.
Thank you.